Prateek Agrawal is with us, Executive Director, Motilal Oswal Asset Management Company. Prateek, good to have you with us here. Thank you very much for your time. Let me just start with what you like in earnings. Where have you seen big earnings upsides? I mean, if you can talk about single stocks, that's wonderful. And what is that causing you to do in terms of investment strategy? Go on.
One, the earnings season has been overall more or less as per expectation. So people are getting very good at projecting earnings. The big positives were financials and autos. But that said, the outlook, to my mind, stays a tad muddled for autos and continues to be good for banks. What we are saying is, as India GDP moves down in terms of nominal growth from 15% last year to 10.5%, as the budget says this year, banks with higher growth DNA may start to find flavor as we go forward. ECL provisioning came up, so that's a new worry. Corporate banks which provided lots in the past would have to, maybe find more provisions going forward, which will again, aid the higher growth retailish kind of banks. So that is one. Second, we believe there are spaces which will continue to do well in spite of the nominal growth slowing down in the economy, such as, let's say, hospitals in pharmaceuticals, such as new age tech, where loss to profit move seem to be gaining traction, such as premium end retailing. To talk of a few differentiators which are there in our portfolios, which track, high quality, high growth space.
By the way, since Prateek mentioned PSU banks, which were under some stress yesterday because of all this chatter about ECL provisioning, they've bounced back this morning. Your Central Bank, Indian Bank, PNB, UCO, all your PSU names are okay. PSU index itself is up about 0.5%. So that's the story on the PSU banking side. Prateek, hi, good morning. Let me just drill down a little further since you mentioned some of these new age businesses. If you can, some color on which types you'd look at. For instance, there's Paytm, where we're seeing more traction, improvement at the EBITDA level. Their losses have come down quite a bit in the quarter gone by. But then there is something like a Zomato, where there's a lot of debate going on about business disruption, whether ONDC is going to change the field for the worse or not. Then there's Nykaa, stock hasn't done too much. So, just what parts of this new age world are you convinced on?
So, as a broad theme, point one, the availability of capital to fund losses and keep gaining market share is evaporating. So the guys who have already done a good job are at a huge advantage versus guys who are yet to do the same. So the larger players in a space are now at a natural advantage. So that is point one. And two, for stock markets, versus saying that a 100 rupee loss of this year will become a 200 rupee loss next year and more the year after, is something that we guys find it difficult to digest. Here, happily, people are talking of, loss of this year evaporating next year into and maybe transiting into a profit. So that helps. 2 out of the 3 names that you spoke about are talking of the same, at least at the EBITDA levels. So that is what makes us positive. There is a huge tailwind of value migration towards online. So, we will debate about online versus online, and that's a very valid debate. But, that move away from brick and mortar to online is a huge tailwind. And after the drop in prices, probably it is time to benefit from that tailwind first.
Hi, Prateek. Good morning. Speaking after a while, Nigel on this side. Prateek, if India is going to be going to that $7 trillion economy or the likes in the next few years, then L&T has a role to play. Now, it had one-off bad quarter, it seems. But how would you approach the stock from here on? It's down close to around 4%, and it's one of the reasons that the Nifty, from being up a half a century, is more or less flat as we speak. Your take?
No, so I usually avoid single stock discussions, but in terms of construct, we tend to stay away from businesses where pricing power is a huge question mark. Okay, because of very high competitive intensity. Now, the way to look at this space is, well, India is growing fast. It will be doing stuff in its growth journey that was not done before, more of it. And there, somebody who has better capabilities versus the lots of the names which are there may stand to benefit a tad. So, you have to look at capabilities. Otherwise, if you see this space, since you spoke of L&T, and L&T is something that we own in the fund, in a small measure, less than index, I would believe, but yes, we have it. Thing is, you look at companies which were there before 2008, this is the survivor. If you look at companies in this space between 2008 and the next cohort, 2014, this is the survivor. 2014 till now, again, the name of the company has changed, and this is the survivor. So, in that manner, it has shown it is an everlasting franchise, good capabilities, and but then the issue on margins will always remain. Issue on order book will not be there. So that is where it is. If you look at the electrical companies, for example, the MNCs and even the domestics, even they are benefiting from strong order books. So the Make in India manufacturing in essence kind of plays, practically everybody is seeing strong order book increases and margin improvements. So, that is what colors our mind. That is how we position portfolios. Look at names where entry barriers are high, rather than names where entry barriers are very low in most of what they do.
Okay, so then you've provided some sort of a way to map this high pricing power, and high entry barriers. I mean, right? So you like banks. You already told us that. What else which fit the criteria right now? And of course, I mean, you have to have. You should be comfortable paying. What stocks are trading in. So what would fit this framework?
So, okay, we like defense companies, the platform ones. Second, we like the MNCs in the, let's say, engineering space. Once again, what they do is seeing less competition, and India in the next growth journey is happy to pay better prices for quality and so on. So it's reflective in margins. And yes, valuations are a concern. But, in many of these spaces, the pace of order book increase is what I think market tracks rather than the current set of numbers and what may happen over the next 2 years. Because in a lot of these businesses, the operating leverage can really play to your benefit if the order booking is seeing a high momentum, apart from positive pricing surprises. So on the engineering side, I think these two spaces. Otherwise, like I told you, hospitals, good combination of sustained growth and valuations. In retailing, new age, not new age, premium luxury and retailing is what we like. So jewelry, so shoes, so wedding clothing kind of stuff is where we are positioned. Apart from, of course, usual names in the leisure space. And like I say, new age tech that we discussed.
All right.
Those are the key differentiators. Otherwise, yeah, we have some banks, we have some other stuff as well.
Okay, Prateek, it's a pleasure. Thank you very much. So defense, engineering, MNCs, hospitals, high-end retail, and of course, so these are a bunch of things that sort of Prateek likes at this moment. By the way,